Hey, what's going on, guys? This is Greg with Idea Trading Ideas, and as you can see, we have our Robinhood account up on the screen and current value at $9,912.18. We're down $32.03 or negative 0.32% for the day, and after hours, we're back up $32.08 or positive 0.32% after hours, right? So, what is this video about? Well, this video is about trade idea, or my trade idea number 13, right? And that's going to be for Atossa Therapeutics. So we have it up right here, and this is the actual trade. Well, it's somewhere around here, right there. That's the actual trade that we've taken, right? So I'm going to show you how you can take this trade as well. So click on Atossa Therapeutics. As you can see right now, it's $4.72, up 31 cents for the day, or positive 7.19%. After hours is up another 10 cents or positive 2.16%, right? So what we're going to do is go through the charts real quick. Weekly chart, we're down $1.57 or negative 24.96%. Monthly chart, we're up $1.63 or positive 52.70%. 3-month chart, we're up $1.77 or positive 60%. 1 year chart, we're up $1.71 or positive 56.81%. And the 5 year chart, we're up 51 cents or positive 12.18%. So overall, over a 5-year time frame, we are up, right? So as you scroll down, you see that I have option contracts in place. 4 option contracts valued at negative $78. Total return, or today's return, is $4 or positive 5.13%, and total return is $32 or positive 29.09%. We have a cash collateral out there of $1,100, and as you can see, we have the Atossa $3 put and a Atossa $2.50 put. We're not going to worry about the $2.50 put because that's going to expire this Friday, and I want to actually show you the trade that we just put in, right? So we've already collected the money for this one. You guys actually can still get in on this one, but not for the same amount of money that I got in for, right? So what we're going to do is get right into it. You're going to click on trade ATOS option, right? So ATOS option, and you're going to go to sell put, and remember, this is the expiring date. So if you went with this Friday, June 18th expiring date, and then started looking at these strike prices, you see that at $4.50 and a $4 strike price, they're offering you premiums. So if you wanted to just deal with this week, then you could say, hey, I think it's not going to drop down to $4.50, or I don't mind buying it at $4.50, and they'll give you 38 cents times 100 shares, which is $38 up front, right? If you decide to pick this deal. Now, you obviously can go down to $4, and they'll give you 18 cents or $18 times 100 shares if you don't think it'll drop down to $4 by this Friday, right? So they give you 2 options for June 18th, this Friday. Now, I didn't do that. I decided to go over here to July and go down to the $3 strike, right? So you see 2 contracts at $3. They're offering me the same amount as they pretty much offered me for the $4 strike or $4.50 strike for last week or this week, right? And I feel like that's just too close. I would rather go out 2 weeks and say, hey man, I don't think it'll make it down to $3 and take this particular strike. Now, I could have decided, hey, I don't think it's going to drop even that low, and decided to take the $3.50 and picked up $60, right? Now I own 2 contracts of 200 shares, which means they would have paid me $120 up front. I decided not to do that. So it just depends on your risk tolerance, and my risk tolerance at this point is not going to be that very high, you know, so I'm going to go with the $3 strike. Anyway, so what you would do is click on the plus sign, and it comes out as short put, $3 put, negative 38 cents. Total credit is $35. Now, if you scroll down, you get a look at my buying power, which is only $99.60. So when we actually continue to go through, it's not going to accept this particular contract, right? I'm just showing you how to do it. I've already did it. So expected profit and loss is $35. ATOS price now is $4.72, right? So as you can see, at a $3 strike price, which is right here, $3 strike price, on up, the max that they're going to pay you is the $35. You break even, which means the price goes from $3 to 265, you're going to break even, $0 at that point. So if it drops down 265, you're going to break even. Anything under that means you're going to be at a loss. So if it goes from $3 once you buy at $3 and drops to zero, you would be negative, because what you're saying is, I'm willing to buy Atossa at $3. So once you purchased it at $3, then if the price decides to go from 3 to 0, you would lose that money in between, which would be $265, right? Because that's 265 plus the 35, and that would be your full $300 that was put up for that particular trade, right? So anyway, then scroll down just to get a good look at all of that stuff. You would click on continue. Now, one contract, right, equals 100 shares, which means that if you go one contract in here, the limit price is anywhere from 35 to 40. Now, I've did my contract for 0.40, and I actually have 2 contracts in play, right? So 2 contracts, which means it's going to be 200 shares each with 40 cents or $40 each contract, right? Minimum credit is $80, which means they're going to pay you $80 up front, right? So you get $80 up front, which is what I did yesterday. And scrolling down here, you see expected profit and loss, $80 plus, and max loss would be $5.20 if it went down to 0. Max break even is $2.60. Max profit is $80 right up front, right? Same exact thing if it goes down to 0. We know it's not going to go to 0, but anyway, you click on review order, and remember what I told you. It's going to say not enough collateral for me, because we only have $99 worth of collateral, and we've already did this particular trade. But for you, it would actually go through, right? So how much money do you need for collateral? You need $600 up front to do this particular trade, unless you decide to change your contract amount to 1, which means that you would need $300 worth of collateral. So if you went with 1 contract, then your minimum credit received would be $40, right? Or in this case, they're offering $38. So that's pretty much how you do this trade. This is how you pick up a small percentage of money over a small time frame. So what we're going to do is click on our spreadsheet real quick, just to kind of break it down and show you. So possible option deal number 13 is active, meaning we're already in it, right? So it expires 16th of July 21st. This is a ticker ATOS. It's going to be a sell put. Current price $4.73. Purchase price is $3. Shares purchase is 200, which means if it drops down to $3 strike price, you would purchase those 200 shares. You don't own those shares right now. You're going to put up $600 as collateral in order to buy at $3 if it drops down to $3. They gave me 40 cents up front per share, or 40 cents times 200 shares, which is $80 in premium profit up front, right? Or 13.33% up front, right? So when you take that $80 from the $600 that you put out as collateral, what you have is now $520 that's at risk. And the time frame is 30 days, right? So that means you're putting your $600 up as collateral for 30 days. On 16th of July, if the share price hasn't dropped down to the $3 strike, you're going to get your $600 back. That collateral that you put up, you're going to get it back. $600 is going to come back to you. You get to keep the $80 regardless. So now you have your $600 back plus the $80 that they paid you, right? Puts you at $680. So this is my trade idea number 13. I'll go ahead and give you trade idea number 14, which is going to be Ameren. We're going to possibly do it for a week, which is this Friday. It's going to be a sell call. Current price of Ameren is $5. Purchase price was $5, right? Which means I'm right at the money. I own 200 shares. It cost me $1,000 to do this deal. I'm going for an option strike price of about $5.50, and we're going to ask for 10 cents, right? We believe that the market, once it comes on today, that Ameren is going to push up higher, and that option strike price for $5.50, we may be able to get 10 cents out of that deal. We own 200 shares, so it's going to be 10 cents times 200 shares, which is going to be $20 up front. It's going to give us a 2% option premium, and if it does sell off by this Friday, we're going to receive a total of $1,100 plus the $20 on top, which will give us $1,120. And this will all be taking place in 4 days, right? So 4 to 5 days. And from there, we're good to go. Now, is this all I've made off the Amarin deal? The answer to that question is no, because I've been doing Amarin covered calls for some time, right? So I would actually come out of this deal maybe around an extra $300. So we get our $1,000 back right here, and we actually are able to pick up 200 plus or 300 plus in terms of the premiums and the sale price, right? So I just gave you a quick preview of, you know, the option deal number 14. You guys can go in and do that if you want to. But anyway, hopefully you guys learned something from the channel today. Please remember to like, comment, subscribe to the channel. I really do appreciate all the love and support. If anything I can do for you guys, hey, just let me know. You guys have a great one. Bye.